The U.S. Federal Reserve has indeed extended Operation Twist to the end of this year. If we can put this in graphics, it will make the picture very, very clear. It was expected to do, one of the options before the Federal Reserve was to do this, was to really extend the QE, Operation Twist, and it has indeed done that. It has left federal fund rates target at 0 to ¼ percentage point. It has extended Operation Twist through the end of this year. So that was the eye on the Fed, and the Fed indeed has said it has voted for the economy. According to the Fed, has expanded moderately this year. Those are comments that are coming in on the Fed. As far as the U.S. economy is concerned, it has voted 11:1 for Fed Form's rate action. It has raised federal rates, like we just told you, rate target from 0. The twist extension to swap about $267 billion of treasuries by end of 2012. It has left federal rates unchanged. More comments coming in from the Federal Reserve on your screens just now. It has extended Operation Twist is really the big breaking news coming in out of the United States. We're going to get you experts in just a bit on this channel. All right, we finally got Douglas Blake, who's joining us all the way from New York of Newbridge Securities Corp, with his take on this move. Douglas, good to have you on this show. As many had expected, the Operation Twist has been extended. How do you think it will really help the United States at this time?
All right, well, this is exactly what we anticipated, and we talked about the idea of the Fed not doing any new easing because of all of the uncertainty out there. This is what you might as well call quantitative appeasing. The market expectations for some sort of action had grown so much that, the Fed probably decided, we have to do something here to show the market that we understand that there's a problem, but we're certainly not going to enact a new round of easing, create new obligations for the Fed's balance sheet. So extending Operation Twist is kind of the safest way to keep their feet moving, in their dual mandate, which of course is price stability and maximum employment. So, this is the kind of thing that the market was sort of expecting. I know a couple of analysts, one at Goldman Sachs, Jim Hatzius, had expected a little bit more, and maybe the market was rallying ahead of this, expecting a little bit more. But at the end of the day, this was the kind of move that I think was reasonable for us to expect from the Fed. Try to flatten out that yield curve, do everything we can to support the economy in its current state before doing additional programs if needed in the future.
Douglas, like you pointed out, the Fed has to be seen to be doing something rather than keeping quiet and keeping its hands off the table. In that process, they have extended Operation Twist. How much of an impact will it really have? Because, QE2 has not really had much impact on jobs. It has not really had much impact on job generation first, on the housing economy. How much of an impact will this really have?
Well, Chairman Bernanke stated himself at the last press conference that it's really up to Washington and central banks around the globe, in the Eurozone, quite frankly, to get their houses in order for the next leg of the economic recovery to ensue. We have all of these problems and all these questions in the United States, everything from tax-mageddon, as we're calling it, where taxes in the U.S. are set to increase dramatically next year when the Bush tax cuts expire, to the fiscal cliff, as we're calling it. We have this massive deficit and this massive debt that we have to start whittling away at next year, which means we're cutting spending dramatically. And that's a fiscal cliff. That's the kind of thing where the economy, without that support from the public side here in the U.S., could potentially fall off a cliff. So we have those issues to deal with, and the Fed has nothing to do with those. Now, what the Fed has done to this point is remained remarkably accommodative for a very long period of time. We've had interest rates near zero since December of 2008. We've had quantitative easing 1, quantitative easing 2, and then this Operation Twist. Whether or not it's been successful, well, there's so much going on around the world, it's hard to tell. Operation Twist kind of dovetailed with the LTRO, the massive bill out of the Eurozone, the long-term refinancing operation that pumped billions and billions of dollars into the economy around the same time. But it did seem as though Operation Twist did something to help ease the U.S. markets and, keep the recovery here going, even at its snail's pace.
You did touch upon it briefly, and which is why I want to chew your brains a little further on this. The U.S. Fed had pointed out that Washington needs to do its bit on the fiscal front as well. Do you see it clearly saying it all over again?
You know, this could be where he goes with this, but I think at this point, you know, that's beyond obvious. What's happening around the globe is because of all of the uncertainty, no one wants to make the first move. So you have China with their economy clearly decelerating. You have the Eurozone and all the issues that they have there and their attempts, you know, to get their arms around the Eurozone debt crisis. And then, of course, the central bank and what seems to be a decelerating economic recovery here in the U.S. But, you know, there are so many moving parts here. Like I said, we do have to address the situation in Washington if we're expecting this rally to resume in any meaningful way here in the U.S. In Europe, you know, it wouldn't make sense for the Fed or China to do anything dramatic if Europe is about to have a financial crisis, because we'll want to have that ammo later on. So for now, I think everyone's kind of in a wait-and-see mode. You could see Bernanke put a little pressure on Washington at his press conference, but he's really limited in exactly what he can do there. So it's almost like, you know, falling on deaf ears. It really comes down to Washington getting their act together, getting on the same page, and getting some decisions made there. And that's something we just haven't seen in years out of our nation's capital.
A very quick question then. There's plenty of political action also coming up in Washington. There's presidential election coming later this year. So not much has really been done in terms of just extending the Operation Twist. How much of a political impact or how much of a political influence has really come on Bernanke's decision?
Well, that's another aspect of, I think, doing something here. Number one, the Fed has to take a bit of a Hippocratic oath where, you know, first and foremost, just try to do no harm. So if they thought that a move here to appease the markets was going to harm the economy or harm the markets, you know, that's the kind of thing they would avoid. But as we get closer to November, if we do see that the economy continues to trail off, that GDP continues to contract, that the jobs growth continues to slow down its pace of recovery, you know, you could see what I guess I can controversially say would be a politically motivated move from the Fed to get the wheels turning. But, you know, that's really using the other side of my brain. That's more political commentary. We'll try to stay to the facts here. And frankly, the facts didn't support more easing at this point. And there's too many unknowns across the globe to even be sure that another round of quantitative easing would work or would have the desired effect at this point. You know, should we get closure from Europe, more action out of China, you know, perhaps we could coordinate that with another round that would take and that would have some teeth. But right now, it's pushing on a string.
Just hold on thoughts there, and there are too many moving points like you're pointing out, but let's quickly check how U.S. markets are reacting to this news. Those are the only live markets that we are tracking at this hour, and it looks like those markets are not taking very kindly to this last check. There you have it, the Nasdaq down about 0.4%, half a percentage point shave off for the Dow Jones at 12,768. Crude oil has reacted very sharply to it, down about 3%. Douglas, I'm going to come back to you and talk to you about interest rates. When do you think the Fed will ever move on that?
Well, that's another tool in their tool belt going forward, in my opinion, for easing or at least targeting some growth in the economy using the tools at their disposal. So interest rates near zero. They've stated that they'll keep them there until 2014. Obviously, you know, to further ease, they could make a commitment to draw down that out even longer, 2015. But at that point, you know, it's like who's counting? So what they could do instead, and I've heard some speculation of this, is set some targets for the economy and say something to the effect of when GDP hits 2.5% or 3%, we'll raise a quarter point. Or when the unemployment rate falls to 7%, we'll consider raising interest rates. Give the people something to really base their decision-making on when investing in the markets, or at least trying to game this Fed policy.
A very quick question then. We were talking about the rally that the markets did see before in anticipation of what Ben Bernanke could do perhaps this evening, of course, according to Indian time standards. But why are markets shaving off right now? Why are markets slipping into the red? And do you think these losses will be sustainable over a period of time, or do you think tomorrow morning the markets will forget about what Bernanke did and go on to trade as usual?
Well, I think there's probably two components here. First of all, this is your classic buy the rumor, sell the news. And so much of what Wall Street was looking for from this announcement was already baked in. We essentially got in line what we were looking for. Another round of easing, probably would have been met with a big rally. But who's to say how sustainable that would have been, as it would have also been indicative of maybe some bigger problems that we're not seeing in the macro picture. But going forward, it's really hard to say how this market's going to perform when it's been so beholden to policy moves. I think, this is a market that's almost addicted to policy actions as opposed to, the economic progress. So it's kind of it's the reverse of what you'd expect. Bad news very often has been received well because it means that, central banks around the globe will act, whereas good news, has been received in some cases poorly, as it means that maybe the funny money party is coming to an end. So it's very hard to say exactly what will happen next. If I again sort of try to come back to reality and just look at the numbers, stocks are fairly priced, corporate profits have been very strong, balance sheets look good. There's not a lot of options out there. You're not going to put your money in treasuries. Gold is a little bit less of a safe haven these days. You almost have to buy the market, but you just have to pick your spots, because if you're in something that's too, economically sensitive, you may have some issues down the road.